Walk us through this story, Richard. Pretty interesting, just given all this uncertainty out there. Some of these trillion-dollar money managers are really having this kind of a bit of FOMO here right now. Is it premature to think about a rally, given what's going on in the markets?
Great question. Well, that is on a lot of fund managers' minds right now because, by definition, at the moment of peak uncertainty, peak fear, that's when the rally begins. And the key point here for fund managers, and if you think about the tens or hundreds of thousands of people around the world involved in this business, they're tracked against benchmarks that will start to tear up and go higher at some point. We don't know when that is, of course. And if they start to lag it in those early days and weeks, it's really hard to catch up. So that's years potentially of performance, always trying to catch up and make sure your benchmarks and your performance against those benchmarks is good. And so that's why it's critical for these big fund managers to be positioned to pivot really quickly. And so we're seeing a lot of them, Franklin Templeton, Invesco, JP Morgan are the ones we spoke to. And they're really moving into neutral positions for traditional fixed income and equity portfolios to really make sure they don't miss the start of the rally.
Is that how investors are positioned? So, just give us a sense of what these investors are really going overweight and owning, with the hope, obviously, that we get some catalyst that kicks off this eventual rally.
Great question. So in the fixed income space, treasuries are really getting a bid from the likes of JP Morgan Asset Management. We spoke to Bob, I spoke to Bob Michel, who's the Chief Investment Officer there, and he's loading up on long-dated treasuries and has been for the past few weeks. And he's basically saying, it doesn't matter if the Fed raises rates another 25, 50 basis points. They will have to pause and begin cutting eventually when the economy starts to slow. And so he's basically saying you have to be holding these securities, these assets, for that moment, because when it starts to go the other way, you won't be able to time the market, and you really need to be involved there. And on the equities side, Invesco shared in some detail what they're thinking, and on equities, they're really looking to shift from defensive positioning in large caps, in defensive sectors like utilities, consumer staples, into those cyclical areas, even into tech they're considering, these areas of the equity market that have been hit so hard last year.